I'm not sure when you may view this video, but at time of recording, we are eagerly awaiting the opening of the World Cup Rugby, which happens today. In a sense, it does seem to feel a bit like the early 90s. Recall late 1993 when markets started to decline and many South Africans were collecting tinned food and felt unsure about the future as a new political landscape dawned. Very early in 1994, things started to recover, and that year the JSE returned 19%. 1 year later, South Africa wins the Rugby World Cup and the euphoria returned. Everything now looked better. Now history may repeat itself, this time in a different order though. We seem to first need to win the World Cup to get our spark back, heighten optimism, and hopefully see the dawn of a new political landscape only in 2024. We only have hope, I suppose. But while we hope and wait, Jeremy Gardner termed it very well. Is this the darkest hour for South Africa? According to the load shedding schedules, probably yes. But looking at the month of August, markets didn't do us any favors. The JSE gave up some of its previous month's gains, closing 5.1% lower. This loss detracted from the year-to-date number, which is now only 2.6% positive. Financial, resources, and even industrials closed in the red, while local listed property managed to end the month on a positive note. It is never easy for the markets if the heavyweights struggle, and this month Naspers closed 8.5% lower, Prosus lost 7.3%, and Richmond 6.7%. The JSE closed on 74,953 points, whereas a year ago it was on 63,727 points. US markets also struggled, and the Nasdaq recorded its worst one-month number for the year, closing 2.2% lower. At the recent Jackson Hole Central Bank Conference, Fed Chair Jeremy Powell didn't indicate whether the Fed is prepared to hike interest rates further if inflation remains too high. He has also shifted the focus to the economic growth number remaining above the long-term average, as well as the housing sector showing signs of recovery. While the markets struggled, the economic data released for South Africa did provide somewhat of relief. CPI continues to slow and came in at 4.7%, mostly due to the lower fuel prices. And most homeowners or anyone probably paying debt had another month without premium increases as interest rates remain unchanged. Furthermore, the ABSA PMI numbers improved for August, rising 2.4 points to 49.7, just below the much-needed 50-level mark needed for an expansionary phase. The BRICS summit was held in Johannesburg recently, where it was announced that 6 countries will join the BRICS group. Argentina, Egypt, Ethiopia, Iran, Saudi Arabia, and the United Arab Emirates now forms part of the new BRICS alliance. The reasons for these countries joining and the criteria for a country to become a member is not yet clear. One very noticeable point is that all the new members have a similar main trading partner in common. You guessed it, China. What potential impact will this have on markets? Many are speculating that de-dollarization is the focus of the newly formed group, though no public discussions were held on this specific topic. Given that we started this month's Market Smarts with a recap of history, our timeline also reminds us of interesting events over the recent 1 year. December last year saw the Rand depreciate 6.5% for the year, and the forward rate agreement shifted higher at that stage, indicating more rate hikes to come. And this was indeed the case. Now, on the topic of time, 91 recently shared a valuable calculation. Time truly is your friend in investing, and they illustrated that if you start early and save for 40 years, and you would like to retire with 20 times your income required at age 60, you can start with 15 times your pre-tax salary as a monthly contribution. However, if you wait and only start 20 years later, you now not only start it much later, but also have less time to save. But if you still want to retire with 20 times your income at age 60, you now need to start saving 60% of your pre-tax salary, which we all know, with the cost of living today, seems very unrealistic. We often ask our managers to share their views, and ALIT this month, one of our preferred equity managers, mentioned that they maintain a balance between locally driven and offshore driven businesses. They believe South African Inc. stocks remain cheap, but for good reason. Their view on inflation is that the worst is over. However, it will take some time for rates to go back to target levels. We are very pleased with the managers we hold, and as can be seen by the latest updated 4-pillar information, the models have done well. This month, we feature the balanced income model portfolio. Having undergone some drastic changes recently, the model now holds more growth assets and more offshore assets. We've discussed the considerations for income investing and the restructure of this model in our last monthly webinar, if you'd like to go and revisit that. According to the 4 pillars, we've done well to deliver a solid outcome, especially when compared to the likes of its CISA category. The model also shows it can improve on the consistency number. While the CISA category average shows how difficult it is to achieve CPI plus 4% over rolling 5-year periods, our model managed to do so more than half the time. It continues to preserve capital against inflation over its mandated period, and as we can see from the managed risk pillar, though the probability is slightly higher to get a negative 1-year return than that for the CISA category, the actual worst 1-year number is less. Now, all 3 of the Regulation 28 outcomes-based models have done exceptionally well, continuing to outperform the CISA categories over the relevant time horizons of 3 years for steady growth, 5 years for guarded growth, and 7 years for optimal growth. The balanced income and stable income models tell a very similar story. View our numbers snapshot if you wish to see all the model portfolio return data, and as always, we include some money fund rates, bond yields, and index data as reference points. I suppose the overarching topic and theme today is that whether it is on the rugby field, in an investment team, or even just as a citizen of this country, we are indeed stronger together. The stronger investment team at Amity has proven over the last couple of years how our robust process really offers value to advisors and clients alike. I hope you all stand proudly behind our South African team, and we hope that they have a very successful rugby tour.